I'd like to get a sense from each of you what you think, what your expectations are for 2011 as opposed to what they were compared in 2010. Kind of generally talking about the overall economic outlook that your firm has.
I guess from our point of view, 2011 in prospect and forward looks a whole lot better than it did in 2010. I think we feel the market has bottomed, probably with 35 to 40% declines across the board. That's a generalization. So the sense is the only way from here, hopefully, is upwards. I think the question is how quickly will that happen? And our sense is that that's actually going to take, obviously, varying degrees of time depending on the particular sector that you're looking at.
I think the big difference between a year ago and today is that the players in the markets in the U.S. now have more flexibility than they did a year ago. Everything was paralyzed, whether you were a borrower or a lender. There were standoffs everywhere. No one wanted to do anything. The whole phenomenon of kicking the can down the road was really mutual. And now with the advent of more equity and debt capital into the markets and with a brighter outlook, people are showing more flexibility.
Generally, the market is very excited about 2011. I think we view it as a real opportunity to take advantage of some markets that have not been somewhat picked over and really take advantage of the pricing that we're seeing.
From our viewpoint, the major challenge continues to be the drag of housing on the economy, but some of the good news is that consumers are moving towards deleveraging. The savings rate is staying around 5-6%, and so both companies and real estate operators and consumers are moving towards a better financial condition overall. In terms of opportunities, the other one that I would mention is that we're starting to see the beginning of clearer opportunities in the distressed debt space. We're seeing that some of the financial institutions are finally getting enough reserves to start letting some of the properties come out, which is creating some opportunities for investors, whether they're funds or wealthy individuals or small private investors.
Are you seeing a greater willingness of lenders to be putting money out for commercial real estate on more favorable terms?
You definitely are seeing that now versus a year and a half ago. CMBS securitization is back. Last year was the beginning of it in a material sense, where there was $15 billion of new issuance last year. This year there's estimated to be $40 to $50 billion. Loan-to-value ratios are going up slightly. There's actually been some concern by the rating agencies about some of the underwritings, which I think will continue to be, they'll continue to be assertive in terms of trying to make sure good underwriting standards prevail on new issuance. So CMBS is back, and that's a good thing to resolve maturing debt. The life companies have definitely been active and have been taking advantage of the marketplace, and some of the stronger banks are back issuing debt. We are seeing other foreign lenders, whether they're from Canada or Mexico or Asia, that are coming in and starting to lend more in the United States, particularly on the trophy properties.
I think, if I can just pick up on that point, one of the things that we've seen through our finance group is that there really is the focus. There's been a huge bifurcation in the market, i.e. the prime properties, the first class trophy, as you referred to them, Greg, type properties against which you can secure incredibly cheap financing at this point in time. But if you went into a lesser quality city in a lesser quality building, you'd still find it extremely difficult. So although there's an enormous amount of debt available in the market, it's very selective and it's very focused on the higher quality properties in the better located cities.
Talk a little bit about the demands that you're experiencing and the expectations you're experiencing from your investors, and are what you are telling these investors about what their expectations should be. Are they aligned? Are they different?
I think, number one, most investors' expectations for real estate investments have come down for a variety of reasons. One is because the overall return environment is so low. And even this morning from Nouriel Roubini, it's expected to stay relatively low. Number two, many of the strategies that expected to get very high, super high returns from real estate have simply not turned out that way. So the highly levered, highly structured investment approach has been certainly put on hold for the moment. And therefore, to put a number on it, if you look at the actuarial assumptions of U.S. Institutional investors, they've come down anywhere from 50 to 100 basis points just in the last year. So they're now hovering around sort of a 7.5% return. So to the extent that they want to invest in real estate as part of their portfolio, they're really not necessarily shooting for the moon. That's number one. And number two, the orientation, if you've seen, just February 14th, CalPERS, the largest U.S. pension fund, came out with a brand new strategy. They had had enough of the opportunistic strategy, and they're now going to devote 75% of all their new money to core real estate through a set of operating partners. So I think that in and of itself indicates at least in that case, a shift back to lower expectations.
Maybe to build on Jeff's point, that return sort of expectation that investors have, if you look at it and compare it to sort of the prevailing bond yields that are existing sort of in the United States, the spread between sort of a real estate return and that bond yield is at historical highs, sort of 350 basis points to 500 basis points. So it is, a tremendous opportunity right now, and obviously the low leverage that, or the low rates on leverage that you're able to put on real estate are making those returns all the more attractive. So it's really been, I think, people going to a flight to quality, recognizing that those sort of cap rates have compressed and that those returns are coming down, but still relative to sort of the alternatives in the market, they're pretty attractive. And I think that that's obviously what we're seeing with a lot of our investors.
Opportunistic investing with respect to distressed assets. What do you think the distressed investment opportunities might be, either in equity or in debt?
We've been tracking the distressed debt market for the last 2 years and have been involved with a number of clients that have made bids and some that have actually won. And I would say to you that number one is highly situational. The way that product is offered to the market, there's a wide variety of ways that it's coming to market. But there seems to be kind of two emerging categories we see that are truly buying debt. One is certain large distressed debt funds which have large teams in place which can deploy people very quickly. The second area is we see small private investors coming in and buying loans that are in the neighborhood or in their marketplaces or maybe competing properties that feel like, okay, I own a warehouse here. There's one in this submarket that I've been following and I've been watching it very closely and I really want this property and I'm willing to pay up a little bit and buy this. And so they're looking at buying the debt as a way to own. I think the one thing that's kind of different about this distressed market than some that we've seen in the past is a tremendous amount of the debt is in smaller size assets. These can be loans that are less than $1 million that are coming out of a lot of the community banks and regional banks. And it tends to be assets that are tough assets to realize cash from. So there are a lot of small balance loans that are going to take a lot of legwork to collect.